Okay, hello everyone. So today we're going to discuss a random topic from chapter 9, monetary policy and its measures, okay? This is one of the most important topic for your exam and even for your general knowledge from this chapter, okay? Now what is monetary policy? Monetary policy is the policy of the central bank, that is the RBI of our country, to control money supply and credit in the economy, okay? Money supply means total amount of money available with the public or purchasing power with the public, okay? And credit means in terms of loans or rate of interest, okay? The central bank adopts monetary policy to achieve certain economic objectives like to maintain price stability, to increase economic growth, to check the exchange control rate, and so many other objectives, okay? So I repeat again, when we talk about monetary policy means it is the policy of the RBI, that is the Central Bank of India, to control our money supply and credit in the economy, okay? Keep that in mind. Now, monetary policy are of two types. One is expansionary policy and another one is contractionary policy, okay? So first we will discuss expansionary policy. Now the word expansionary itself implies to increase or to raise aggregate demand, isn't it? So expansionary policy is applied in times of depression, okay? Depression means when there's a low period of income, output and employment, which means there's a low period of aggregate demand, okay? So this policy is applied in times of depression in order to solve the problem of excess supply. Excess supply means when supply is more than demand. Now why there is more supply than demand? Because people have no money with them to spend on goods and services, right? So here the central bank policy is to increase aggregate demand, okay? That is to solve the problem of excess supply. Now in order to do that, the central bank adopts quantitative and qualitative measures, okay? So first we will discuss the quantitative measures. Why quantitative? Because here its aim is to increase the quantity, to increase credit, okay, or measured in terms of quantitative, okay. So there are various tools used by central bank here to increase aggregate demand. One is repo rate, reduce it. Two is open market operation, buy securities. And three, we have cash reserve ratio, reduce it, okay? So what is a repo rate? Repo rate is the rate at which central bank lends to the commercial banks, okay? Now this repo rate is only for a short-term loan, keep that in mind. It is for a period of 7 days, 14 days and 28 days, or we can also say less than 90 days, okay? So here what the central bank will do is the central bank will reduce the repo rate. Now once the central bank reduce the repo rate, then commercial bank will have more money with them, which means their lending power will increase, okay? And when they have more money with them, then producers will take more loans from them, which means more money will be available with the public to spend on goods and services, right? And aggregate demand will increase, okay? So at present our repo rate is 4%, okay? Keep that in mind. Number two, we have open market operation, buy securities. Here the central bank, that is the RBI, will buy the government bonds and securities from commercial banks, which means the RBI is paying money to the commercial banks. Now when RBI pays money to the commercial banks will have more money with them, and when they have more money with them, they have more power to give loans to the borrowers, to the producers, or to the public, isn't it? And when public have more money with them, which means they have more money to spend on goods and services, and that is how the problem of excess supply will be solved, since their aggregate demand will increase, isn't it? Okay, point number three is cash reserve ratio, okay? See, cash reserve ratio and statutory liquidity ratio are two important tools of a central bank that is adopted on commercial banks, okay? When we talk about cash reserve ratio, it is a compulsory amount of money that the commercial bank must keep with the central bank, okay? At present, our CRR is 3%. And when we talk about statutory liquidity ratio means a certain portion of money that a commercial bank must keep within themselves from their total deposits. And at present, our SLR is 18%. Okay, so here our main point of discussion is the central bank will reduce both CRR and SLR so that commercial bank will have more lending power within, because when commercial banks have more lending power within, they will be able to give more loans to the public. And when people have more money within, that is the public, they will spend more money on goods and services, and that is how the problem of excess supply will be solved. Okay, I hope that is clear, right? Okay, now coming to qualitative measures. Why qualitative? Because here its aim is to improve the qualitative tools, okay, or it's measured in terms of qualitative. So the first one is margin requirement. Now before we discuss the point here, let me tell you what is a margin requirement. Margin requirement is a financial help or loans given by commercial banks to the borrowers against some security. Okay, now let's say when a borrower, a producer, wants to borrow money of rupees 10 lakhs, the banks, that is the commercial banks, will demand some security. It can be in the forms of goods from the borrower. Okay, normally the commercial banks will lend less than rupees 10 lakhs, say rupees 8 lakhs, and keeps 2 lakhs as margin requirement, which is fixed by central bank. Okay, so here our main point of discussion is that central bank will reduce the margin requirement so that it will encourage the borrowers, or it will encourage the businessmen, the producers, to take more loans, more credit from the commercial banks in order to raise aggregate demand, isn't it? Okay, so point number 2 is moral suasion. In a situation of deficient demand, that is, aggregate demand is less than aggregate supply, the central bank will pursue its means, convince or request or appeals or advise its member banks, means its commercial banks, to be liberal in lending and expand credit facilities. Okay. Third is rationing of credit. It means fixation of credit quotas for different business activities, which means here the central bank will fix a different rate for different loans to the commercial banks so that public will borrow or producer will take more loans from the public, and which will promote social justice while taking stake of depression. Okay, and lastly we have direct action. Now you see, whatever we have discussed above are all policy of a central bank given to commercial banks, isn't it? Now in case if the commercial bank fails to comply all the rules and regulation given by the central bank, the central bank have a right to take actions against those banks which do not comply with its directions. Okay, so I repeat again from the beginning. When we talk about monetary policy, means it is a policy of central bank to control money supply and credit in the economy. Okay, this monetary policy is important, considered as the most important tools to control our economy, because with the help of monetary policy there's price stability in our country, there's increase in economic growth, and there's stability in exchange control. Okay, and monetary policy are of two types: expansionary and contractionary monetary policy tools. When we say expansionary, means to increase aggregate demand in order to solve the problem of excess supply. Okay, so it is further divided into quantitative and qualitative measures. Under quantitative, we discuss repo rate, open market operation, cash reserve ratio, which means to reduce all those repo rate, open market operation, cash reserve ratio to increase aggregate demand, isn't it? Now coming to qualitative, we have margin requirement, moral suasion, rationing of credit, and direct action given by central bank to the commercial banks in order to maintain our economy into equilibrium or stability. Okay, so once you understand this expansionary monetary policy tools, contractionary policy tool is just opposite to what we have discussed. Okay, so you go through, and contractionary policy will be your assignment. Okay, thank you.